Most business owners think higher profits come from selling more, finding more customers, or simply working longer hours, but that's rarely the real answer. The truth is that many businesses never reach consistent profitability because they never develop strong financial habits. Revenue alone doesn't build a healthy company. Financial discipline does. In this video, you'll discover 7 money habits that successful business owners consistently follow to build stronger, more profitable businesses. The first habit is understanding your cash cycle. It may sound simple, but it's one of the most powerful financial practices successful entrepreneurs rely on. Instead of focusing only on how much they spend, they pay close attention to how quickly every dollar comes back into the business after it's invested. Most owners ask, how much does this cost? Successful owners ask, how long will it take for this investment to pay for itself? Imagine you spend $500 on digital advertising and customers begin purchasing within 5 days. That's a fast cash cycle. Now compare that to buying inventory that sits on shelves for 3 months before it's sold. That's a much slower cycle. Or think about paying for office space that doesn't generate additional sales or improve operations for months. That money is tied up without producing an immediate return. Once business owners begin measuring how quickly cash moves back into the business, they naturally start making better financial decisions. They negotiate payment terms that allow customer payments to arrive before major bills come due. They order inventory in smaller, more frequent batches instead of tying up thousands of dollars in excess stock. They focus their marketing budget on channels that generate customers faster and eliminate campaigns that take too long to produce results. The shift is surprisingly simple. It's no longer about choosing the cheapest option. It's about choosing the option that keeps cash moving. Businesses with healthy cash cycles often grow using their own profits, while businesses with slow-moving cash frequently rely on loans or lines of credit just to cover everyday expenses. Developing this habit creates greater financial stability, stronger cash flow, and far less stress. The second habit is pricing for profit from the very beginning. Highly successful business owners don't set prices by copying competitors or matching industry averages. Instead, they evaluate every price through a series of financial questions before offering it to customers. They ask whether the price fully covers costs, leaves enough operating profit, supports healthy cash flow, provides room for unexpected problems, and creates long-term value for the business. Many owners only compare what a product costs with what they plan to charge. That's one reason so many companies operate with extremely thin profit margins. Successful business owners ask much deeper questions. Will this price still work after future advertising costs? Can it absorb refunds, warranties, or product replacements? Will the business remain profitable if discounts become necessary or distribution costs increase? Will this price leave enough money to cover taxes, loan payments, and future growth? When a price survives all of those tests, it generates real profit instead of simply producing more sales. As a result, charging premium prices no longer feels uncomfortable. The question changes from, is this too expensive, to, will this price help keep the business financially strong for years to come? That single shift transforms pricing from a marketing decision into one of the most important financial decisions a business can make. The third habit is connecting every expense to a measurable result. Most businesses carefully record expenses using accounting software or spreadsheets, but many never stop to ask what each expense is actually accomplishing. Successful business owners make sure every significant expense is connected to a specific business outcome and a reasonable time frame. For example, investing in software should save time, reduce mistakes, or improve efficiency within a few months. Hiring a new employee should increase revenue, improve customer service, reduce workload, or strengthen operations over a defined period. Marketing campaigns should consistently generate qualified leads or build brand awareness that eventually converts into sales. As they review spending, successful owners naturally group expenses into 3 categories. Some expenses actively create growth by increasing sales, improving efficiency, strengthening customer loyalty, or raising profit margins. Some expenses simply keep the business operating without creating meaningful growth. Others consume cash without producing measurable results, adding unnecessary complexity while reducing financial flexibility. Once every major expense is connected to an expected outcome, decision-making becomes much clearer. Instead of worrying about spending money, owners understand which investments are producing results and which ones need to be eliminated. This habit prevents unnecessary overhead, protects cash flow, and encourages smart financial discipline without becoming overly focused on cutting costs. Perhaps most importantly, it changes the mindset of the entire organization. People naturally begin asking, what results should this investment produce and when should we expect to see it? That's one of the reasons financially healthy businesses are able to grow without putting unnecessary strain on their finances. The fourth habit is building strong business credit before it's ever needed. This is a strategy that isn't discussed very often outside financial institutions, yet it's one of the smartest long-term habits successful business owners develop. Instead of waiting until cash is tight to think about financing, they strengthen their company's borrowing profile well before they ever need additional capital. Successful business owners don't wait until they're facing a financial emergency to think about borrowing money. They prepare long before they ever need funding by steadily building a financial profile that lenders, investors, and financial institutions trust. They know that strong bookkeeping, consistent cash flow, responsible credit usage, healthy debt coverage, accurate tax filings, and a reliable history of paying suppliers all send powerful signals about the health of the business. Why does this matter so much? Because capital naturally flows toward businesses that appear stable and financially responsible. Companies with weak credit profiles often end up paying higher interest rates, accepting unfavorable loan terms, or getting denied financing altogether when valuable opportunities appear. Businesses that intentionally build financial credibility, on the other hand, create multiple ways to access capital when the time is right. They qualify for business lines of credit, establish strong relationships with vendors, secure business credit cards with better terms, finance equipment when needed, leverage invoice financing if cash flow tightens, and inspire greater confidence from investors. The goal isn't to take on unnecessary debt, the goal is to have options. When the economy slows down, when sales become seasonal, or when a major expansion opportunity appears, businesses with access to capital are able to move forward while competitors are forced to stand still. If a competing business closes its doors, financially prepared companies can purchase equipment or assets at attractive prices. When a large customer places an order that requires additional working capital, they can accept the opportunity instead of turning away revenue because cash is too tight. This habit isn't about borrowing today. It's about making sure your business is financially strong enough to borrow tomorrow if the opportunity is worth it. That level of preparation often separates companies that simply survive from those that continue growing through every stage of the business cycle. The fifth habit is planning for future profits instead of only reviewing past results. This is one of the most valuable financial habits successful business owners develop, yet it's rarely emphasized in traditional business advice. Instead of spending all their time looking backward at last month's financial statements, they regularly look 3 to 6 months ahead and estimate where the business is heading. Many owners only review reports showing revenue, profit margins, and expenses after the month has already ended. By the time a problem appears in those reports, the damage has often already been done. Successful business owners create simple financial forecasts for future sales, operating expenses, inventory purchases, payroll, tax obligations, and debt payments. Those projections don't have to be perfect. They simply need to provide a realistic picture of what's likely to happen next. If they know business typically slows down in 3 months, they begin reducing unnecessary expenses before the slowdown arrives. If they expect a major contract to require additional working capital in the next couple of months, they arrange financing early or negotiate customer deposits before cash becomes tight. If quarterly tax payments are approaching, they set aside money gradually instead of being caught off guard when the payment is due. This habit makes profitability something that's planned rather than hoped for. Instead of constantly reacting to financial surprises, business owners stay several steps ahead. Payroll doesn't become a crisis. Tax deadlines don't create panic. Annual subscriptions and contract renewals don't suddenly strain cash flow. Even slower sales months become manageable because they were anticipated well in advance. Looking ahead also creates something every entrepreneur wants but few experience consistently: confidence. Rather than worrying about money every day, successful business owners can clearly see what's coming and prepare for it before it becomes a problem. That's one of the biggest reasons truly successful companies remain profitable year after year instead of relying on short periods of good luck.